Hello everyone. In this video we discuss about the different factors that affect the firm's dividend policy, and the first main factor is the legal constraints. And in legal constraints I just discuss about the two factors, and first is the definition of the legal capital. Like the definition of the legal capital is different in different countries. Like in some countries legal capital is defined as the par value of common stock, but in some other countries legal capital is defined as the par value of common stock plus paid in capital. So whenever board of directors decide about the dividend payments, whether they should give a dividend or not, or less or more dividend, definitely first of all they will see what is the definition of the legal capital in their country. So this is the one factor which affect the dividend decision, dividend policy. And the other factor is sometimes some companies limit their board of directors to pay dividend. Like if a company apply a condition that board of directors will not pay dividend more than their let's say recent retained earnings plus past retained earnings. So if there is a condition that company will not pay dividend more than the recent retained earning plus past retained earning, so it means that dividend, if this is the condition that dividend amount should be less than these two, so it means that definitely board of directors will consider this condition that they will pay dividend less than the sum of the amount in these two accounts. So there are many other type of restrictions in different companies which restrict the board of directors to pay dividend to some dividend up to some limit, and the board of directors will not be able to pay dividend more than these limits. So I just discuss here the one example of the limit. So other factor which affect the company's dividend policy is the contractual constraints. Contractual constraints, like when company borrow a loan from a bank, so sometimes banks on a loans impose some conditions. When company's financial position is not good and they're going to take a loan from a bank, further loan from a bank, definitely then bank impose the conditions on a companies. Like I just gave you example, like against the loan the one condition can be that the firm will pay maximum 5% of their earnings as dividend. So I just write it one condition, like when any company will go to take a loan and bank impose a one condition, which is that the firm will pay maximum 5% of their earning as a dividend. So this condition will restrict the company to pay dividend more than 5%. So company board of directors will just have an authority to pay dividend up to 5% of their earnings, because they have one contract with their bank, and in this contract they have signed a contract, and the one condition of the contract is this, and after this condition the board of directors can only pay dividend up to the 5% of their earnings. So there can be many type of conditions on the loans, and when there is a condition on the loans, then definitely these type of conditions will limit the dividend payments to the shareholders. Other is the growth prospects. If company has a plan to grow in future expansion plans, then how can company finance their future expansion plan? Definitely through retained earnings or debt, there can be three sources: retained earning, debt, or equity. They can issue a share for a future expansion, they can take a debt from a bank, and third is the retained earning, internal source of finance. So when company has a future expansion plans, like if one company is going to start a new product in the next year, definitely they will finance this product through these three sources. So when a company has a future expansion plan, definitely company will pay a less dividend or no dividend. Why? Because when company pay less dividend or no dividend, definitely retained earning amount will increases. So when company has a future expansion plan, normally companies pay less dividend, and due to this less dividend, retained earnings will increase and our future funding need will be decreased. So, and if company do not have a future plans, definitely then company have a less requirement of cash in future, definitely then companies pay higher dividend. So this is third factor. So if company want to grow in future, definitely they will pay less dividend. They will save this money and invest this money in the next year rather than giving a dividend today. So fourth factor is the owners consideration. Owners considerations. There are many of the owners considerations. I just discussed few. Like one of the main owners consideration is that if firm pay dividend, if dividend pay, then company definitely will have a less cash, because when company pay cash dividend, then cash will be reduced, and then when cash will be reduced in future, there is a probability that company will have to take loan from bank or issue share in case of big need of cash in future. So one of the honest consideration is that if they pay dividend, definitely in future, if they pay dividend, definitely their cash amount will be decreased, because they pay some of their cash profits in form of cash, transfer this cash to the shareholders in form of dividend, then their cash amount will be decreased in financial statements. And when cash amounts will be decreased, then there is a probability that if in next year they need a big amount of money, definitely they will have to go to the bank, or they will have to issue a shares. So if they will go to take a loan, definitely their bankruptcy risk will be higher. Bankruptcy risk will increases. So if they issue shares, definitely their ownership will be transferred to the other parties as well. So it means that we call this phenomena as the dilution of ownership. If they issue a share, their dilution of ownership. So there are two major concerns. If company pay higher dividend, then cash will be decreased, and if cash will be decreased in this year, definitely next year company might needed. There is a chance that company need a big amount of cash in future for investment purpose or any other purpose. So if they need a cash in next year, definitely they will go for a loan option or issuing a shares, because they have already paid a big amount of dividend and they have a less retained earnings. So when this is the scenario, then if they go for a bank, their bankruptcy risk or credit risk will be increases. And if they go for issuing a new shares, definitely if they issue new shares, their own ownership percentage will be decreased. When their own ownership percentage will be decreased, their ownership will be diluted. This is a major concern of the family firms, especially family firms, where definitely to control the firms properly, or to maintain their specific percentage of board of directors, they need a specific percentage of the shares definitely when they issue new shares in a market, their own family's ownership will be decreased and definitely their ownership will be diluted. So these are the major concerns of the owners as well when board of directors are deciding about the dividend. So if firms are the family firms, definitely board of directors are also from the family, definitely they will pay less dividend. And I have my own research as well. According to my research in Pakistan, dividend family firms pay a very lower dividend as compared to the non-family firms. So significantly lower dividend is paid by the family firms. Their concerns might be related to this option, dilution of the ownership. So this factor also affect the dividend policy. All this consideration also affect the dividend policy. And the fifth factor is market considerations. So there are some market considerations as well. Like for market considerations, I just discuss one theory, which is a catering theory. Catering theory. According to this theory, if there is a boom in market, so shareholders prefer to take dividend in future or prefer capital gain. And if there is a recession in a market, like right now in COVID-19 there is a recession in the markets, so shareholder definitely prefer a dividend payments, and rather than a future dividends payment. In this session, investors prefer to take a dividends, but if economy is in boom, definitely investor will prefer, according to this theory, investor will prefer a capital gain or future dividends. So definitely market considerations also affect the dividend decisions. So all these factors affects the dividend policy and dividend decisions. And when board of directors are deciding about giving a dividend to their shareholders, they consider all these factors and many other factors. So these are the major factors which affects the firm dividend policy. Thank you so much. Now move to the next